I think that the capital side of the equation now is much more aware of what the occupier is doing. And I think that, we talk about the bond yields, we talk about, I think the decisions that people make are much more driven by occupier trends and what they're doing. I think that the weakness of Paris as a market is perhaps driven by that. And I think that that lack of recovery has been a problem. We looked at some stats recently which showed that, labour costs in Spain had gone down significantly as Spain had re-engineered its economy. And, a lot of manufacturing has moved from France to Spain. And so it's interesting that within our own, economy of Europe, occupiers and manufacturers are moving to lower cost environments. London and the rental growth you've seen in London is driving performance. And I think that's one of the reasons why new capital comes here so comfortably, because, you can see performance. Whereas going into a lot of the recovering markets, you've got very low performance in those markets. And so, you're looking quite a long way out in terms of driving performance in comparison to the UK. And as you said, when Jos mentioned the kind of numbers that the REITs are benefiting from here, the REIT sector in Spain is now recovering. You're seeing a recovery of the public markets. But that's the one way you can show performance, whereas in the direct market it's actually more difficult when you haven't got that occupier performance going on at the same time.
And I was just saying, I think France is difficult. We manage a number of funds there, about 700 million of assets. One, if I make Johnny redundant in Paris, I've got to pay him at least a year's salary and probably find him a job. So that the structural reform that economy needs is pretty significant. Two, we're just not seeing any sort of occupier flickers in retail, industrial, logistics, secondary offices, even central Paris offices. I mean, we're really not seeing much in terms of, occupational sentiment and activity improving. And then three, to what you were saying, Richard, actually, we have a fund which raises money from French individuals, high net worths, to invest in German retail. And we can't get enough of that. I mean, the French high net worths are desperately keen to deploy in Germany right now. And then that fourthly also relates to debt. So in Germany, there's huge availability of debt. It's an incredibly competitive market. You can borrow at sort of 1 all-in for a 5-year bullet loan. France, there ain't a lot of debt, and if there is debt, it's pretty expensive. So that whole relative thing of where you are on returns on equity and cash on a levered position, France v Germany, it's Germany every time at the moment.
And so that's driving much more capital in that direction,
yeah.
You think, and will do more so over the rest of the year, in essence.
I think definitely. There's a lot of interest in Germany, particularly given where debt, the competitive availability of debt, it's almost like a carry trade.
But I think when you look at it, though, Jos, you're going to see the amount of capital that we have in the market has to find a home. And I think that a lot of more secondary real estate looking for higher returns, these portfolio deals we were talking about earlier, you're going to see that in France. And I think that there are huge amounts of real estate held in funds, that are coming towards the end of their lives. And I think this will get traded. And I think you're seeing that the easy trades are going on at the moment. You're seeing a lot of the big portfolios, a lot of the things that are going on at the moment are trading relatively core plus. But one of the trends we're seeing is you're beginning to see more and more challenging stock being sold because the market is very strong and the capital is driven towards it. And so not every capital raise wants to focus on core office. And so that's why that's going to be I think a positive thing for a lot of these markets.